Hello friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about credit needs in order to boost growth in the economy. So we will discuss here what are the credit needs of the economy and how these credit needs, if properly met, can boost the growth, that is GDP of the economy. And we will also discuss about what are the challenges in meeting the credit needs in the economy and what is the background of these challenges, how the global financial crisis have impacted the credit needs of the economy, etc. So before we begin, this is our channel StudyIQ and we are providing pen drive courses for various competitive examinations including SSC bank courses, UPSC optionals, SSC JE courses, teaching examinations, railway examinations, defense examination, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, law examinations like CLAT exams, state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details or you can call to any of these numbers for more information. Now, let us first understand what is the current credit scenario in the economy. If we look at the estimates of unmet credit needs of the credit-worthy Indian companies and small entrepreneurs, it is for credit-worthy Indian companies, the credit needs that are unmet is around $500 billion and for small entrepreneurs it is $1 trillion. So it means that there is unmet credit requirements in both small entrepreneurs category and also big Indian companies. Now coming to current GDP of the country, the current GDP of India is around $2.8 trillion and the total outstanding credit of India is around $1.8 trillion. So if India is able to close this gap of total outstanding credit, this will boost the economic growth. Now coming to private sector leverage in India. So private sector leverage means total private credit to GDP. So the private sector leverage in India is only a fraction of that is in other large economies. So in large economies or developed economies, the private sector credit or the ratio of private sector to GDP is huge, but in India it is very less. So this means that the government or the policy makers needs to pay attention to both quality of credit growth and also the delivery channel, whether it is from private channels or from public channels. So both the delivery channels and the quality of the credit growth needs attention from the policy makers. Now we will come to the recent credit crisis in India. During the financial year 2009 to 14, so during this 4 to 5 years, there was a substantial amount of credit going to large projects with lengthy durations for return of capital. So during this period, the financial institutions in India provided credit to large projects with long duration. And notably, this is the time when NBFC, ILNFS also started providing loans to larger projects with long duration. So we have discussed already about ILNFS crisis. You can refer to the video ILNFS crisis for more details on it, how it impacted the NBFC sector, how it impacted the liquidity and how it led to a liquidity crisis in the NBFC sector, etc. We have discussed that. So for more details, please watch the video on ILNFS crisis which is available on our channel StudyIQ. So during 2009 to 14 financial years, what happened is that the banks utilized their funds for lending for long-term projects with long duration. But actually this should have been filled by the bond markets. But instead the financial institutions lended to these large projects. And after the 2008 global financial crisis, these large projects eventually led to vast majority of NPAs or non-performing assets in the financial institutions. So this was one major reason why there is a increase in NPAs or non-performing assets, especially in the government on public sector banks. And recently, in the recent years, the Reserve Bank of India, which is the monetary authority of the country, had gone for tightening of norms for bad loan recognition. It had imposed prompt corrective action or the PCA framework on certain banks, including 11 public sector banks. etc. So RBI has also taken very tight regulations during these years, and this has led to deleveraging in the scheduled commercial banks. So what is meant by deleveraging? It means reduction in the leverage ratio. So reduction in leverage ratio means that the percentage of debt in the balance sheet has come down. So if we look at a bank's balance sheet, the percentage of debt or the lending of banks came down because RBI adopted tightening monetary policies, including PCA frameworks, etc. for the scheduled commercial banks. And this deleveraging by the scheduled commercial banks has led to unmet credit requirements in the economy. So this was one major reason. But at the same time, during this period when there was a deleveraging by the scheduled commercial banks, a portion of this gap was met by the bond markets, by the HFCs, housing finance companies, NBFCs, non-banking financial companies, etc. But still, the bond market or the HFCs or NBFCs were not able to fill the entire gap due to the deleveraging of scheduled commercial banks. And now within the bond market or the HFC or in the NBFC, there were many crises, including the ILNFS crisis in the NBFC sector. In the bond market, bond issuance slowdown, and several issues were there in the bond market, HFCs, NBFCs, etc. So this had widened the gap of unmet credit. So this means that many entrepreneurs or many business that needed credit did not get credit from financial institutions, because on one side the scheduled commercial banks had adopted a strategy of deleveraging, that is bringing down the percentage of debt in the balance sheet. RBI also adopted tightening monetary policy or tightening regulations, which led to lesser credit flow in the economy. And thirdly, the other sources like bonds, HFCs, NBFCs also had certain crises within themselves, which led to lesser cash flow or credit flow to the economy. So all these factors have led to lesser credit flow and thereby widening the gap of credit requirements or unmet credit in the economy. Now let us understand what is the optimal credit share. So if we talk about the credit share as a proportion of the GDP, the bank credit is roughly the same in India and the US. So as a percentage of GDP, the bank credit is almost the same in US and in India. But what makes the difference is that the total private credit is almost 3 times in US compared to India. So we have already seen this. The source of credit in US is mainly from private. So in India, it is almost a 1/3 as in US. So this suggests that the big gap between the outstanding credits in two countries, the United States and in India, is primarily in the bond market or in the NBFCs. So from this we can conclude that it is the bond market and the NBFCs that should grow significantly faster at this point. Now we need to focus on private credit, and therefore the bond market needs to be enhanced and the NBFC sector also needs support from the policy makers. So the difference between the credit flow in US and India mainly lies in the source of the credit. So in India, it is largely from public sources like scheduled commercial banks, but in case of US, it is mainly from private sources like the bond market or from the NBFC market. So now we need to focus more on NBFC and also on the bond market. Now coming to the biggest challenge for India, we have seen that the source of credit must be shifted from public to private. So here public to private means that it should be shifted from scheduled commercial banks to private sources like the bond market, NBFC or the HFC. And this is the major challenge for India. The ways to shift the large loan projects from banks to corporate bonds is a biggest challenge for India. And in this regard, what can be done by the country or the economy, we will discuss now. Firstly, we will consider the MSME sector, that is marginal, small and medium entrepreneurs. So in case of MSMEs, MSME sector provides employment to almost 40% of the total workforce, and it also contributes to around 37% of the GDP. So the significance of the MSME sector in the Indian economy is very huge. Now, The MSME sector is also the largest underserved market. That means the credit requirements of the MSME sector is largely unmet. There is a huge or wide gap between the demand for credit and the supply of credit to the MSME sector. And in case of MSME sector, the HFCs, NBFCs, the bond markets have played a major role. So enabling credit growth to the MSMEs, that is micro, small and medium entrepreneurs, is a wise option. Now, Mudra loans can also play a major role here. The criteria for the Mudra, that is Micro Units Development and Refinance Agency, the criteria for which should be revised, and this should enable broader selection of NBFCs in order to qualify for refinancing Mudra loans. So this should cover more NBFCs, and covering more NBFCs under the Mudra scheme will enable the NBFCs to provide credit to the needed sections. And the HFCs and the NBFCs needs to be strengthened, and both the policy makers, the monetary policy maker, the RBI, and also the fiscal policy maker, the government, should focus more on enhancing HFCs and NBFCs to help them mitigate the risk factors and also to enable them to narrow down the credit requirements. And in this regard, the choice of bonds available to banks and insurance companies also needs to be broadened and revised. So broadening of the pool of potential buyers of bonds is likely to increase or boost the corporate bond market, and this will also accelerate GDP growth in the economy. And as a concluding note, we can say that a significant portion of Indian economy will significantly grow if there is an increase of credit flow to these economies. So, increase in the growth of these economies will contribute towards GDP growth or the economic growth of the economy as a whole. You can find the PDF of this lecture on my Facebook page, and also for any queries regarding your preparations, you can get in touch with me on my Facebook page, or you can email me at joycey.studyiq@gmail.com. Thank you.